Okay, I'm going to be putting all of this together because one of the final pieces just came in today. And don't worry, I'm going to get to all of it, but this is a lot to digest. But it's really not that complicated because, again, they've been telling you what they're doing since August of 2019, and it's been led by the biggest player in the market, BlackRock, who is, in and of itself, an arm of the Fed and is a big, big role into everything that's happened since COVID, basically. Now, you can think what you want of COVID, if it's real, if it's not real, I'm not going to get into that. I just want you to pay attention to this. And I want you to understand after reading all this that without COVID, none of what I'm about to read to you would have happened and none of it would have worked. So I'm going to put all this together. There's going to be two parts. This one is the actions that took place and led to some of the things that we saw while rates and inflation were low. So this is going to be the period of time between 2019 and April of 2020, and then April of 2021. And then when we get to that point, I'll do another video that goes over the actions and important events that took place as rates and inflation were increasing to record 40-year highs. So putting it all together, we're going to start back from in 2019 in August. And it all started with, of course, this BlackRock Investment Institute, Macro and Market Perspectives. This letter was written in August of 2019, and it was titled Dealing with the Next Downturn, From Unconventional Monetary Policy to Unprecedented Policy Coordination. Now, a lot of the biggest CEOs from around the globe all got together, signed basically a consent form to this, saying they would work together, blah, 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 and they would do everything necessary to, preserve the greater global financial system. That's what this plan was basically outlining. Again, they're very direct in what they were telling you way back when, before the COVID pandemic was really even aware of as a problem to begin with. So setting the scene, this is on the cover page. It's basically, unprecedented policies will be needed to respond to the next economic downturn. So they're basically telling you before the downturn happens, this is before the downturn happens, that there's a downturn coming. Monetary policy is almost exhausted as global interest rates plunge towards zero or below. Because remember, at this time, interest rates were near zero. It was destroying the interfund lending market. Nobody could get rates because they were too low. So they had to run to the Fed because they needed the higher rates. And inflation expectations are dragging at this time on actual inflation. And we're going to get into this letter real quickly, and then I'll get into the more important stuff. So from the chart perspective, this is the S&P 500. This is the time period when this was drafted and when all these CEOs around the world got together to draft this uncoordinated or unprecedented monetary policy coordination that the world has never seen before. Now, the summary of this document, this is my summary, the best I could come up with after I've read this document several times over. Basically, this paper written by BlackRock argues that in order to effectively respond to the next economic downturn, an unprecedented coordination between monetary and fiscal policies are necessary. The current monetary policy space is limited due to low global interest rates. That was the issue. And fiscal policy alone may not be effective with high debt levels. So in essence, we had too much debt to raise interest rates without some form of intervention. Now, the intervention is this. BlackRock proposes a framework to achieve coordination through a monetary financed fiscal facility, which would be activated, funded, and closed by the central bank to achieve an explicit inflation objective and would be deployed by the fiscal authority. Sound familiar? This facility would have clear boundaries to preserve institutional credibility and would include an explicit inflation objective, nimble deployment of productive fiscal policy, and a clear exit strategy. The size of the facility would be determined by the central bank to achieve the inflation objective. Now, again, remember, this was all written before any of this stuff happened. And they're telling you right here, what they're referring to is this: the United States reverse repo facility conducted by the operations desk in the Federal Reserve. That's exactly what they're referring to. This is exactly what they were referring to. Excuse me. Now, the problem then, inflation was too low, debts were too high. In a downturn, effective stimulus will require coordination between monetary and fiscal policy, which is exactly what BlackRock was saying, either implicitly or explicitly through measures such as direct credit to private or public sector accounts or buying equities. Buying equities. That is important to remember. Now, helicopter money is a form of monetary and fiscal coordination. Again, there's that monetary and fiscal coordination where the central bank increases its balance sheet to directly inject money into the economy through a tax rebate or public spending. Not printing money like everyone misclaims on the internet, but through tax rebates or public spending. Completely different. Now, this direct injection of money is meant to boost spending and increase inflation, but it must be permanent and coincide with an increase in the stock of money to avoid crowding out private investment. Monetary financing of government debt has a long history, but ended in the early 1980s when central banks focused on limiting inflation. Again, 40-year highs for inflation. This extreme form of monetary financing can lead to hyperinflation if not controlled, but there's little experience in using it to achieve just enough inflation for price stability. That's helicopter money. So again, think about this. Effective stimulus will require coordination between monetary and fiscal policy, either implicitly or explicitly through direct credit to private or public sector accounts or buying equities. They're telling you right here. And then what did BlackRock, Fidelity, and Vanguard do in early 2020? They did exactly this. They bought up equities to the tune of having over a combined asset under management of over $20 trillion at that time. That's exactly what they did. And they told you right here before it even happened. Now, again, the problem was inflation was too low. Now, it's telling you right here, helicopter money is a form of monetary and fiscal coordination where the central bank increases its balance sheet to directly inject money into the economy. Now, look at this shit. This is 2019, just prior. Remember, the Fed entered in September 2019. What happened directly after that heading into 2020? Their balance sheet skyrocketed. Big time. Because why? Why did it do that? Because they're going to directly inject money into the economy through a tax rebate or public spending. Now, also in the downturn paper, basically, this is the framework that was proposed in this paper. A framework was proposed for coordination between monetary and fiscal policy to achieve the inflation target during an emergency situation where interest rates cannot be lowered and a significant inflation miss is expected. The Standing Emergency Fiscal Facility, or SEFF, is what they were calling it at the time, would be activated by the central bank, with the size determined based on the inflation target. That is exactly what the repo is. Its size is determined by the forward-looking SOFR rate, which is a whole nother thing that goes on top of all this, LIBOR to SOFR, that I'm not going to cover in this one because that is a whole nother topic in and of itself that started, a little bit before the Fed stepped in. This is just regarding COVID and what most of us have witnessed. But there is more to go with this in LIBOR to SOFR. That's another big part of this. Now, the SEF would operate alongside automatic stabilizers and discretionary spending and would finance a temporary increase in fiscal stimulus. The central bank would hold yields at zero, and monetary policy would operate similarly to yield curve control. So at this period of time, you see how this right here is flat? That's when the Fed funds rate was at zero, during the time that Fidelity, BlackRock, and Vanguard were doing what we just said a second ago, buying up equities throughout the entire market. You can go to Fintel right now and look at their balance sheets. Back then, they had trillions of dollars in assets under management. Trillions. Because they bought up everything under the sun during this time. Now, this framework could include a temporary price level target and would be a more practical approach compared to monetary financing alone. The SEF could also operate quasi-fiscal credit easing by purchasing private assets. Having a credible policy response plan in advance could increase its effectiveness and reduce the amount of stimulus needed. So again, the stimulus checks were a byproduct of exactly what they were trying to do in basically be able to increase inflation, increase the rates, but not cause a detrimental risk adverse effect to the private sector or interfund lending market that was currently dying at that time. Now, having a credible policy response plan in advance could increase the effectiveness. The risk of losing central bank independence and uncontrolled fiscal spending would need to be addressed with boundaries in the policy coordination framework. Now, part two. This is before all of that I just read was before any of this happened. That is what is important here. Then the Fed enters shortly after this is released in September of 2019. This is the chart when the Fed enters, exactly September 17th of 2019. They came in to effectuate a multitude of liquidity facilities to help provide liquidity to all of the biggest players and institutions during this credit crunch. Because again, credits are the interest rates are at zero, near zero, and interfund lending is dying. So let's continue on. Again, the Federal Reserve entered the markets in September of 2019 due to increased volatility in the overnight lending markets and to help maintain the federal funds rate within the target range set by the FOMC, or the Federal Open Market Committee. The Fed conducted a series of temporary open market operations to provide liquidity to the financial system, all of those of which have been closed out, like your supplemental liquidity facility. There was over 11 of these facilities that were basically inducted during this time. But basically, this action helped stabilize the functioning of the federal funds market and support the effective implementation of the monetary policy that BlackRock clearly outlined in their document that we covered at the beginning of this video. Now, again, what did they also tell you? That the assets on the Fed's balance sheet would likely increase to artificially inject the economy with stimulus. Now, this is the markets tanking in March of 2020, while all of the biggest institutions decreased their liabilities and capital. They basically lateraled it all over to the Fed. The Fed took all those assets in, as you can clearly see here, during the same period of time that the markets declined here big time. It's the biggest since we've seen in almost a decade at this point. The assets in the Fed's balance sheet skyrocket at the same time. Fed balance sheet increases as the markets plummet in March of 2020. Now, liabilities and capital held by depository institutions also plummeted during this time as the Fed's balance sheet rose. This is what I was saying a second ago. Liabilities and capital, the blue line here is deposits, these are other deposits held by depository institutions. And the red line is your liabilities and capital. This is deposits with the Federal Reserve banks other than reserve balances, which involve U.S. Treasury. And then you have the green line, which is assets, securities held outright, U.S. Treasury securities. So what do you see here? U.S. Treasury securities skyrocket, but what goes down immediately after the Fed takes over? This is the start of 2020 here. All of their liabilities and capital skyrockets just before a major policy effectuation is implemented, and that is Regulation D. Now, they amended this. So what's the next step in this story here? Well, now that the monetary policy has been set, the Fed is in, their balance sheet is risen, the assets and liabilities of the biggest players have been reduced. Now they amend Regulation D to stimulate the economy to effectuate the bail-in, approve interfund lending relief, and modify the supplemental leverage ratio to allow banks to continue lending at 0% interest now that they have everything under the sun in their inventory. So SLR was amended at the very bottom of the dip that we saw in March of 2020. And real briefly, the supplemental leverage ratio is a supplementary capital requirement imposed by regulators on banks intended to ensure that they have enough capital to absorb losses in the event of a crisis. The SLR is calculated as a percentage of a bank's total leverage exposure, which includes off-balance sheet items. That is key to know, such as certain derivative contracts and securities financing transactions, or SFTs, another foreshadow right there. The SLR was modified in 2020 in response to the COVID-19 pandemic, with regulators temporarily providing relief to banks by exempting certain Treasury securities and deposits held at the Federal Reserve from the calculation of the supplemental leverage ratio. The modification was aimed at providing additional support to banks and promoting lending to households and businesses during the economy downturn caused by the pandemic. Now, again, the downturn was predicted before the pandemic, but you see the pandemic come out, and now all of this is because of the pandemic. It's nothing about the downturn letter was mentioned that basically foreshadowed everything that I just covered from the BlackRock letter that happened prior to all of this, 6 months prior. Now, again, Regulation D, which governs bank reserve requirements, was amended also prior to the stimulus checks in 2020 to give banks more flexibility in managing their liquidity during the COVID-19 pandemic. This amendment allowed banks to count certain types of municipal deposits as a partial substitute for reserves, which reduced the amount of reserve requirements they needed to hold. So, I mean, it's like 2 plus 2 is 4. They lateral all the assets to the Fed. The Fed, it has rates at zero. Inflation is incredibly low. They buy up all the assets in the market. Then the market tanks as they pass it over to the Fed. The Fed's balance sheet skyrockets, and now they amend Regulation D and SLR. And by the way, the IRS issued 3 economic impact payments during the coronavirus pandemic for people who were eligible. $1,200 in April of 2020, $600 in December of 2020, January of 2021, and then we had one. I'm sorry, there's 4 total. Hold on. Okay, that should say 4. Sorry, there was 4 total in throughout this time period. There was one in April 2020. There was another one in December of 2020. There was another one in January of 2021. And then we had a 4th in March of 2021. And I believe the 3rd one may have been split into 2 different months. So maybe it theoretically does count as one. But we had 4 rounds of payments. But either way you look at it, no matter how you look at it, all of these stimulus checks were sent and implemented and issued during the period that the SLR was amended. It was only amended between April 1st of 2020 to April 1st of 2021. That was the only time frame that the SLR was amended. That happens to be the time frame when all of the stimulus checks were issued. There's one more thing to talk about before we move on with this. On top of Regulation D being amended, on top of SLR being amended, the SEC comes in at this time to provide temporary additional flexibility to registered investment companies affected by COVID-19, permits funds to use additional funding and other tools to manage their portfolios for the benefit of investors. Do you see how disgusting this company is now? Because you and I know that by reading clearly the document outlined by BlackRock, the COVID-19 pandemic, if you take it out of the equation, this plan would have still worked. But in order for the people to, take the reasoning behind it, what would people be okay with? Everyone working together in the industry under mass collusion and in monetary and fiscal policy and coordination efforts never before seen on a global scale, or a global pandemic caused by China? China. I mean, you tell me. It's obviously the latter of the two. Sounds way more convincing and way more divisive than if they were to know that everyone under the sun, the SEC, the Fed, all of the biggest depository institutions, everybody involved was working together to basically engineer everything that just happened. Now, interfund lending relief allowed large financial institutions to temporarily use assets from one fund to support another fund in times of stress. This is why you see ETFs inside of ETFs, inside of ETFs, inside of mutual funds, inside of index funds, which are inside of other index funds, inside of other ETFs, because it's all interlinked together, because it's allowed to be, because the SEC provided this relief back in 2020. And again, they get to do this without having to count those assets as borrowed for regulatory purposes. This provided a temporary buffer that allowed these institutions to address short-term liquidity needs without triggering regulatory consequences, such as restrictions on activities or penalties. By having this relief in place, large financial institutions were able to better manage their financial stability during a period of increased market volatility, reducing the risk of default. Again, this is the time period when stimulus checks were issued. You had one here, 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 and here. Only during the period of time when the SLR was amended. Now, the interfund lending relief is still going on to this day, just so you know. But you're telling me, right at the end of all of this downturn, all of a sudden, Regulation D is amended, SLR is amended, interfund lending is given to these biggest players, and then the market goes on a year-long bull run and pushes to all-time highs. And people are going to tell me that retail moves markets. No, sir, that is not correct. Not correct one bit. That's what they wanted you to think when you entered the markets, most of you, in late January of 2021, because they wanted you to think that you moved GameStop and AMC. But at the end of the day, we all don't have billions and billions of dollars laying around. So the supplemental leverage ratio relief expired when? In April of 2021. That's when the repo market enters the picture, because that happens to be the exact moment when the repo demand skyrocketed in anticipation for the upcoming rate hikes. Now that they have all the assets, now that they have all of their liabilities handed over to the one entity that can't default on them, the Fed, now that they have all of the lending relief, all of the Regulation D municipal deposits relief, now, and they, by the way, they also have the stimulus checks issued that they can now use because they fall in that new category of Regulation D, by the way. Now that all of that is taken care of, now they can go on and increase rates and increase the demand for the repo. And I have this paragraph here next to this because at the beginning of this video, if you remember, BlackRock proposes a framework to achieve coordination through a monetary financed fiscal facility, which would be activated, funded, and closed by the central bank to achieve an explicit inflation objective and would be deployed by the fiscal authority. This fiscal would have clear boundaries to preserve institutional credibility and would include an explicit inflation objective, nimble deployment of productive fiscal policy, and a clear exit strategy. The size of the facility, this facility right here on the bottom of the screen, this is exactly what they're referring to, the SOFR, or the overnight repo facility. The central bank sets the size of this, which they have. This is only the half of this story. And, I left a lot of stuff out. There's more that goes on to this. But, I hear a lot of people saying that, no one knows what's going on. There's no way anybody can know. That's bullshit. There is a way that you can know. You have to read the correct documents that are basically written by the biggest influencers of the markets: BlackRock, the Fed, and anybody else that has a big stake and big skin in the game in the markets. Retail doesn't have skin in the game in the markets. Collectively, we take up 10% of market movement as far as liquidity is concerned, or from a monetary perspective. We provide basically riskless principal for them to utilize in a bunch of different methods, rehypothecation, municipal deposits, things like that. We are nothing but liquidity providers. And especially with all of the move towards options with retail traders, options don't move the market unless they're exercised. And last time I looked, most people aren't holding thousands of shares of Apple, AMC, or not AMC. People have thousands of shares of AMC, but I'm talking more like your big wig names like Apple, Facebook, Tesla. Only the 10% of wealthiest American households own and trade those securities as far as the underlying. But as far as you and I are concerned, in the majority of retail, we don't do shit except provide them liquidity and payment for order flow. There's no other way to go about it. If you believe retail moves markets, you're kind of still caught in the ape mentality from GME and AMC. There is a plethora of evidence I just showed you that debunks all of that nonsense. So again, this is all planned. It has been planned from day one, since August of 2019, probably sooner, probably all the way back to when, LIBOR to SOFR really got going in early 2018. But this has all been planned. And as far as today, what happened, what you saw, and again, it was a good play. You could have made money both ways, but in the long run, we're not done here. There's still downside to see, and all of this bull conversion is exactly what they want. So just hang in there. I think we may have a couple of weeks left in the tank for the upside move, but there's downside coming because they're not done here. And the not supplemental, but the capital charge amendment from the SFT just passed today. which is a big, big thing that's been waited on since last year in July of 2022. Basically, the SFT service was stalled out because they needed this amendment to pass, which just now got approved today. The timing, I mean, it couldn't be more perfect. So, anyways, that's basically the first half of this while rates were low. And at the point we finished, that's when the job was done. They did the first half of their project, and the next half is to basically increase the rates, increase the repo demand, get the SOFR rate where it's needed, get inflation where it's needed, so we can pay down our debt as a country. That's basically it. And this doesn't include, obviously, other global aspects such as China's three red lines policy. I didn't get into all that. There's a lot more to this, but as far as the U.S. side is concerned, these are the major things that took place in the first half of this story. So hopefully you learned something here.